Hello, everybody, and welcome. My name is Barry Merrick. I'm co-founder and CEO at Ivy and the chapter chair of YPO Metro New York. And it is my absolute pleasure to introduce all of you to Sir Martin Sorrell. Martin, welcome. How are you today?
I find I'd much rather listen to Jerry Mulligan and Chet Baker than this.
Well, don't worry. In 60 minutes, we'll be back to the soundtrack that you so nicely chose. Really excited for our conversation today. And I want to thank you on behalf of our whole community for being here today. We're all excited to get your guidance on how we can be the best leaders that we can be. And before we dive in, as everybody knows, Martin is the founder and executive chairman of S4 Capital, and he's also the founder of WPP. He was actually the CEO of WPP for 33 years, and he built it from a £1 million shell company in 1985 into what has become the world's largest advertising and marketing services company. So by the time Martin left WPP in April 2018, its market cap was 16 billion pounds, revenues of 15 billion pounds, profits of 2 billion pounds, and 200,000 employees across 113 countries. And for those who maybe expected Martin to relax after that achievement, he very quickly launched a new venture called S4 Capital, which he currently runs. And S4 today has more than 4,000 people across 30 countries with a market cap of 2.8 billion pounds. So Martin, you have had such an extraordinary journey. And before we dive into the rest of our conversation, I really want to start by asking you, what is the vision that drives you both in business, but also more broadly in life? And how has that vision evolved over time?
Well, I'm probably unlike other people you've interviewed, or I don't sort of have some sort of portentous or pretentious view of that. I mean, I when I was at B school, I remember I did in the first year, it was a compulsory course. There was a professor called George Cabot Lodge. It was the son of Henry Cabot Lodge, who I think was the Secretary of State in the Eisenhower regime. And we didn't think George really deserved his professorship. I think it was called PBE, Planning in the Business Environment. It was a bit of sort of early ESG type course. And George, in order to get an A on the course, all you had to do was to reproduce 3 circles interlinked, the 3 circles representing family, career, and society. And I reproduced those 3, that Venn diagram, the 3 interlinking circles, and I got an A-. I didn't get an A or an A+, I got an A-. And I was very pleased with myself. And I thought it was, and in fact, most of my colleagues thought it was useless. But I have to say that I think actually it was quite valuable, because what he expressed in that very sort of simple concept was the things that we have to counterbalance. So you obviously have family, you obviously have your career, and you obviously have society. And it's very, I've met people, and probably I'd include myself in it, who managed to get 2 of the 3 right, or at various points in time, 2 of the 3, but very difficult to get all 3 right at the same time and for a long period of time. So I've always thought of, maybe I was 20, I was part of the most naive class at the Harvard Business School. Dean Athos called us, it was the time of the Vietnamese draft, and I was the 2nd youngest in the class of 700, and I was 21 when I went there, and graduated when I was 23, which was certainly atypical. And as Athos said, actually we fulfilled the original requirement of business school of Harvard, which was, McKinsey and Goldman took you for 2 years, you went to B school for 2 years, and then you left. So the average entry age in my year was about 23, 24. Now it's much older. And I think that's a mistake, but I think it should be younger. But they used to say experience is better for the case study method. But anyway, coming back to George and George Cabot Lodge, I think he was right. So getting that balance right is crucial, I think. and very difficult to do. And sometimes you get two of the three, sometimes one of the three, sometimes none of them. And very rarely do you get all three in balance. So I tend to look at it that way.
Excellent. Thank you, Martin. And just in terms of, your transition from, WPP to S4, as I was saying in the intro, many might have expected, maybe you paused the business stuff there, yet you chose to create something extraordinary very, very fast afterwards. Share with us, how you think about allocating your time and what the decision-making was there for, creating a brand new venture and growing it so fast.
Well, I didn't want to retire. I was 73 when I left WPP, and I've been running it for 30, or I started it from scratch with two people in a room. And so I've been doing that for 33 years. And the average life of a CEO on the FTSE 100 probably is about 5 years. Now, that's a bit of a cheat because we entered the FTSE about 97. So it was really, and I left in 18. So really it was about 21 years, but it was four times the average, I guess, of the average CEO. But I wasn't particularly interested in doing a portfolio. I didn't want to do non-executive work. I didn't want to play golf. I didn't want to do private equity. I don't want to offend anybody on the call who's private equity, but I think they're too short term. And my dad said, build a brand for the long term, which, by the way, may be wrong. I mean, the other interesting statistic, I think McKinsey said the average firm, S&P 500, FTSE 100 lasts for 17 years. And my dad used to say, find an industry you enjoy, find a company in the industry you enjoy, build a reputation. If you fancy doing something on your own, do it when you're 40 or so. But, he spent his life with one company, and he sort of thought that myself and others should do the same. And he may have been wrong, and I may be wrong, that life is so volatile now and changes are so strong that that's not the right thing to do. But I believe in building long-term brands. So I don't find private equity with a 5-year horizon. They're looking for the exit before they make the entry. And I don't think that is something that I would enjoy. So I wanted to, the other thing was, three reasons really. One is my mother's genes. I probably inherited her genes. Secondly, I didn't want to do the portfolio stuff or play golf. And thirdly, when I was at WPP, to be blunt, came under some criticism for the company plateaued in 17. Our revenues were flat. And, that we criticized maybe for not moving into digital fast enough. So what we're doing at S4 is demonstrating that we can move fast enough, and we can win in a digital world because we're purely digital. We're not interested in anything traditional. So we're covering half the market at the moment, but it will be 70% of the market by 2024. Maybe even more by 26, probably about 75% by 26. So we're in the growth market. The other thing is, Barry, the dynamics of total shareholder return have changed. When I was at Saatchi before WPP and WPP, I would say it was about even Steven between top line growth and margin driving total shareholder return. Now, it's about top line growth, not in the absence of margin, but let's say 2/3, 3/4 top line growth, and 1/3, 1/4 the bottom line margin. And therefore, I wanted to do something in growth. I was 73. I was fed up with pushing on a closed door, so I wanted to push on an open door. So the vision was built around digital. It was built around creating a new model, a new advertising and marketing services model, because the old model was not fit for purpose and past its sell-by date, been in operation for 70 years. The market share model with competing brands, the holding company model, have been in existence since the 1950s with Marion Harper at IPG, and it's a busted flush. And so a digital only, because that's where the growth is. Our model is data-driven content distributed through digital media. We go to market as faster, better, cheaper. So agility, understanding the digital ecosystem and efficiency. And lastly, unitary structure. One firm, no fragmentation, no earnouts when we do deals, strictly half shares, half cash.
Brilliant. Thank you, Martin. And, it's such a powerful reminder of what you talked about, building a brand in the long run. As you said, the world is changing so fast, yet, those very best brands are the ones that are built to last over the long run. So in your career, you've made your fair share of acquisitions, right, and hires. So my question to you is, what is the framework that you use when you're partnering with somebody or hiring them, given your long-term approach? How do you make those decisions, and what would be your advice to us as we think about building our own long-term brands?
Well, everybody varies, but if I look at it, and I'm talking about S4, first of all, let's deal with sort of companies that we bring in, because we started with 0 2.5 years ago. We're now $3.5 billion, $3.6 billion market cap, and almost 5,000 people in 31 countries. I would say in terms of the deals that we've done, and the most important, the first question, and for example, this evening after we finish, I'll be talking to somebody about joining us with his company. And the first question I asked him, as we have done for everything else we've done, is if you want to sell your company, we're not interested. What we want is somebody to buy in to our mission. And our mission is to create that new advertising and marketing services model and disrupt the old model. And we're disruptors. So we're Amazonian or Teslan, to use some grand examples. And so we want people who are going to buy in to the mission. They're missionaries and they're zealots. And we're not primarily financially driven, but that reinforces what we do. So what we want, and the structure of our deals is always half shares, half cash. We don't think earnouts, what we used to do at WPP, is the right structure, because it creates too many silos and fragmentation. And as I said, the fourth fundamental principle was a unitary structure. So what we're trying to do is to create a McKinsey or Goldman, again, to use grand examples, with one brand, one P&L, no cross-charging, no competing political vertical interests. So that's what we're trying. So that's core. And then in terms of companies, in terms of criteria, top line growth is the most important. Decent margins, which we would define EBITDA margins at about 20% plus. We're doing about 21, 22 after central costs. So probably around 23, 24, or a pathway to those margins. Thirdly, no vulnerability to technological change. I mean, people think we're a sort of MarTech company like the Trade Desk, but we aren't. We're more a tech services company, like an Accenture on a grand scale or a Globant on a smaller scale, although we attack it from the sales and marketing function rather than the IT function. So no technological or limited technological disruption. And then finally, and this is really important, a strong unification of management and control. I struggled with economics at Cambridge before I went to HBS, but I did read a book there by a man called Robin Maris, who was a left-wing Marxist economist probably, and it was called The Theory of Managerial Capitalism. And what he pointed out was that managers and owners, are two different things, and the key was to unite the two. And I think this is fundamental. If I was running a fund, an investment fund, an asset management fund, I would look for those companies where there was a strong identification of ownership and management, and not a split, because most companies, the people running them, and this is caustic, but I'll be caustic, most companies, they run them as managers because it's a job. So, I believe in Bill Shankly was a famous Liverpool manager, way before Jurgen, who's had success at the COP just recently. And Bill Shankly used to say, football is not a matter of life and death, it's more important than that. And so I think the company should be more important than life and death. It's the company that counts. So unifying ownership and control. So management, the fourth criterion is management must have significant interest. One of the problems with private equity is management's interest gets more and more diluted. And we're seeing much more of that in the market because they're our chief competition on deals. The holding companies have disappeared. Accenture, to some extent, Interactive has disappeared from the fray. But private equity are very strong. They have 2 trillion or thereabouts of unlevered equity. So they're really of dry powder. So they're really in there. So those are the criteria. Now, in terms of people, we want that missionary zeal. I mean, there are the smarts and the intelligence, but, you know, Barry, the honest answer is when you see it, you know it. And you know the motivation that we're looking for and the characteristics that we're looking for. And those are the sorts of criteria that we think about.
And thank you, Martin. I also had the opportunity to struggle with economics undergrad before HBS. And when you talked about that, you know, the management and control and what you talked about now, like you're bringing in these missionaries, these zealots, you want them to have ownership and skin in the game. Share with us, once you are with these individuals, whether it's the senior management, but also everybody else working in the company, what have you found to be the most critical ingredients towards creating an environment where such people can actually thrive? What do you think, like, what should we all be doing more of and less of to, you know, when we do have individuals like that?
Yeah, I mean, it's difficult to describe. I mean, we have, I mean, the average age of, we have, as I said, about 5,000 people, just under 4,800. And of those, 800 are in data and digital media, which is 30% of our business, and the other 4,000 are in content. The average age of the content people probably is around about 31, 32. Average age of the data and digital media probably about 27, 28. And so we're dealing with a younger workforce. So the things that we're all concerned about, you know, which, you know, I have a real problem with the purpose brigade, if I can put it like that. That's not because I think that what they're trying to do is wrong, it's right. And I believe in all the principles around E&S. On governance, I think owner-controlled companies are better run than, so I like dual class structures. We have that at S4. We didn't have that at WPP. But I agree with the E and the S and the purpose, but I think it's very easily dealt with. We over-intellectualize it. Maybe Barry, you know, in Building Ivy, you made this front and center a big part of your curriculum, and it is stimulated interest, revenues, and God knows what for you. But I think it's very simple. And I go back, ironically, it was what John Brown, who was running BP at the time, said at Stanford Business School in 1997. And that was, if you're in business for the long term, everything falls into place. So if you're running an oil company and you're only interested in the short term, you rip the oil out of the ground, you don't care about the environment. Take a very crude example. If you're in it for the long term, you will think about all your stakeholders and the impact on your stakeholders doing it. So, you know, I think Milton Friedman was right. The role of the corporation, or the aim of the corporation, is to drive profit, but it's long-term profit. It's not short-term profit. And once you put that hyphenated word into the mission, we're in it for the long term, everything falls into place. So I think all of Klaus Schwab's, you know, fourth industrial revolution, stakeholder theory, they're fine, and intellectually they might hold together, but I think it's unnecessary. And if, you know, the problem with private equity, for example, is it's too short term. The problem with fund management is they're remunerated and incentivized on too short-term a basis. So although the corporate governance wonks will say to you, we want you to think about purpose and ESG in the long term, the fund managers are still focused on quarterly earnings. So you get this dichotomy. Now, the fact that we control our company means that I can take, and we can take long-term decisions which might be against the interest and profitability in the short term. But we take them because we know if we make a mistake in the short term, we're not going to get kicked out because we control the company. The problem with, it's very interesting. During the pandemic, most people leading companies in our industry were terrified of saying that they were going to do better, because if they overestimated where they were going to be, they get dinged and they might even get kicked out. And so what it does is it makes people leading companies, in my view, too conservative. It's as plain as the nose on your face that if GDP this year is going to grow by 5 to 6% and next year by 4 to 5%, we're going to have a really vibrant economy. We can argue about how long it's going to last, whether there'll be retribution or a problem in 2023. But the reticence of people, people get scared to really express what they really feel because their lawyers are telling them they mustn't exaggerate, their PR people are telling them to hide, or whatever it happens to say. It makes them innately too conservative. So in our organization, one of the things that we're 55% of our revenues come from tech companies. Our biggest client is Google. Our second biggest client, we're NDA'd, but it's a big telecommunications company. It's one of the FANGs. You can imagine who it is. Number 3 is BMW Mini. Number 4 is Mondelez. Number 5 is Facebook. We have a 6th coming up now, which is, we call them Whoppers. These are companies that generate more than $20 million of revenue a year for us. And there's a 6th coming up, which is a telecommunications company. Now, these are all basically, or 3 of them, 3 of the 6, 4 of the 6 are tech or telecoms companies who, in my view, look at the sky and they don't look at the boots. And I think that's, you asked me about how do you sort of motivate people. If you're sort of working with companies that are expansive, that are positive, that are not negative, that are not driven by procurement functions or finance functions. I'm not saying that procurement, I'm an ex-CFO. So I should be more than anybody appreciative of procurement and finance functions, but it can kill businesses. And the politics in big ad holding companies, and I've got to say in clients, the politics is it's a killer. The silos, the geographical silos, the functional silos. The biggest task is to get everybody in the company aligned around the purpose, the mission, whatever you want to call it. That's why we're so keen on the unitary structure, because we saw with the holding company structure, which in its day was the right structure, when you had conflicting accounts and the industry was a very different industry, it was the right structure. We've moved on from that. Clients want integrated execution, the much overworked word, seamless execution. You cannot do that if people don't share the same vision, if the structure doesn't reinforce the vision, and you don't implement around that. So the simplest thing to do, in our case, is to create a unitary structure. Very easy to say, very difficult to do. Very difficult to do, by the way, coming back to the right sort of people. Entrepreneurial people often don't like structure. They don't like a unitary structure. And if you're good, I always used to say, good people are difficult. Average people are easy. average people will always do what you want them to do. That's a dangerous thing to say, because average people think to be good, they have to be difficult. So it can sometimes get you into trouble. But I really believe strongly in a industry structure, but dealing with it when you're trying to get entrepreneurial people, you're trying to get people, who have a very significant management interest in your company, ownership interest in the company. That's a difficult thing to do. It's very difficult to execute, even at small scale. And we're relatively small scale. We're 5,000 people versus, if I exclude associates, as company we own 20 to 50% of at WPP, it's about 130,000 people. So we're operating at a very different scale. And by the way, that might be a very good thing. It may be, again, going back to my father and the advice that he gave me, that the model has changed, that it's a more disruptive climate, things change rapidly, and maybe those people who start things, build things in the early stages and then sell them, maybe that's a better model. Maybe it's a mug's business to run a business for the long term. Maybe, and I'm a mug.
Thank you, Martin. Those are powerful thoughts for all of us to reflect on. And when you talk about this, in the long term, everything falls into place. I mean, we know that you're not just saying that. 33 years, you were the longest running CEO, FTSE CEO. And this, what you're saying is like, in the end, it is simple. If you're making it truly for the long term, then the stakeholders and the people need that environment. And I guess for all the companies you're acquiring and partnering with now, they are joining something with a strong vision.
Well, we use the word, you use the word acquire, we use the word merge. And people think that's semantics. It isn't, because we're actually trying to get people to partner to create the new model and disrupt the old. So, by the way, there's a very strong, I'm going to use the word chip on our shoulder, because in the content area, Media Monks, which is the heart of our content practice, was a production company. And the traditional agencies would sneer at them because they said they were only really production. And on the data and the digital media side, it was mighty hyphen. This was a chicken shit little company in San Francisco that run by people from the tech industry. So they were sort of both demeaned, and I think wrongly demeaned. And so we are a bit chippy.
Got it. Sometimes that's a good thing, right? So really appreciate you sharing these thoughts, Martin. Let's really build on everything you were saying now and look at what you consider to be the most critical trends of our time. So there's a lot going on, but what would you say are the most important trends? And if you could also just share with us those trends in the context of what mistakes you observe people making. I got a long career to draw back on in terms of experiences. Seeing these new trends, where do you think maybe companies are really going wrong, or leaders are being short-sighted given what's at stake? Okay,
well, it's apple pie and motherhood, really, because there are two buckets as far as I'm concerned. One is geographical and one is technological. So the geographical bucket first. When I was at WPP, I think we were first to see it's Jim O'Neill's brick analysis at Goldman and the bricks analysis and the next 11. So identifying those markets, which in those days would offer greater growth. So if I look today at S4, we're 70% North and South America, we're 20% EMEA and 10% Asia. I want to be 40, 20, 40. Although I have to say that in the short to medium term, being 70% North and South America, and the stuff that we're looking at to add beyond, we're committed to doubling the size of the company over 3 years organically, so excluding deals, which is an organic top line growth rate and bottom line of about 25%. So for example, for 21, we're actually targeting more than 25%, but the market, we're told 25%. I think actually for us in the short to medium term, with Biden pumping in, what was it, 1.85 trillion, and now another in the infrastructure bill, etc., probably another 2.25, 2.5 trillion. These are huge amounts of money in the context of a US economy, which is what, 24 trillion. So we haven't seen this before, and that's the reason we're going to get 5 to 6 this year on GDP growth, probably more in America than that, and 4 to 5 next year. You have to go back to the 1980s to see 2 sequential years at that level. And in those days, in the 1980s and 1970s, you had inflation. Now, you haven't had inflation yet. We may get it, but you haven't had it yet. So it's interesting that that's happening, happening now. So I think being in the US in the short to medium term, given the stimulus, certainly in 21, 22, is really the place to be. 23, I think we may have to, that may be, we may encounter some economic difficulties because somebody's going to have to pay for this. And it will be increased corporation tax. We're already seeing that with the Biden recommendations, wealth tax, income tax, etc., capital gains tax. So at some point in time, I think maybe Biden has gone, or he's threatening to go a little bit too far, and will overheat, and then will overshoot, and there'll be a correction in the real world in 23, which means markets which look 12 to 18 months ahead, maybe the end of this year, will start to worry about. They've already started to worry about inflation, with the 10-year yield running up to what, 1.77 or whatever it is. So I think geographically, in the long term, clearly China will be the world's biggest economy in 28. India will be following rapidly behind it. There's a massive shift taking place. This is apple pie and motherhood, but it will be stimulated by what's happening. Having said that, there's a big challenge. Now, if you said to me, what do I worry about most? Sure, I worry about the impact of globalization on industries, driving some and shrinking some. I worry about climate change. I worry about the pandemic. I worry about Brexit. I worry about digital transformation. But one of the things, if not the thing that I worry most about, is the rift between US and China. Trump was applauded by the US business community, in my experience, for taking China on. IP, technology, all the things. Biden is no different. He will approach it differently. He has approached differently, multilaterally, pulling in the Germans, the French, the Italians, the British, etc., to put pressure on China. But the result is the same. We have this rift between the 2 most powerful economies in the world. And the US has great difficulty, just like the British, when they lost their empire, had difficulty. The Americans are having difficulty in coming to terms with the fact that there's another horse in the race, and it's a G2 world. And I think that's the biggest problem. So when I look at trying to build, we doubled up in China at S4 this year from a small base. I want to do more, but I'm really worried by what I see in China. I see millennials taking an anti-Western view and a pro-Chinese view. I see Chinese companies more willing to work with Chinese agencies or whatever than multinationals. It's not make China great again, or maybe it is. I mean, this is their response, to these claims around China virus, or China being villainized. During the election, I saw decks from the Republicans and the Democrats, anti-China decks. Why? Because that works at the polls. So I think that's a real massive issue. And it's, you've got an Indian-China problem as well. And then, by the way, on the other side with China, they haven't helped because Xi, who will be there until at least probably 2035, just like Putin could be. Xi, what's he doing? Hong Kong, Taiwan, Philippines, Australia, gum on the shoe, the wolf warrior stuff. It's tough stuff. And China, the chasm or the gulf is widening. And you saw in Alaska the rhetoric around when Blinken met the Chinese foreign minister. You saw the rhetoric around it. Now, maybe in private discussions it was better. Maybe that was for public consumption, but it's really worrying. So that's one thing. The second thing is technology. We always underestimate the speed with which technology kicks in. In my case, I went back, I said, the case of WPP, I was criticized for not moving fast enough. There may be something in that. We always try and preserve the analog type of business because that's the cash cow that's generating the profits. We're making investments in digital, which are more top line focused, and expenses, no object. Let's go, and when you're running an analog company, it's very difficult to balance that. Interestingly, the pandemic blew a hole in that, because in Q2 of last year, most companies' profits fell by 50%. I just read a breaking news cut before I came on to talk to you, which said, companies are going to have the comparative Q2 last year, and earnings are going to be up 50%, because they're cycling a very weak Q2. So even we, who didn't have a down month last year, our worst month was +3 organic in April of last year, and we grew last year by 20% overall. Even we will get a lift, because March of last year we were up 7. This year, I won't tell you what the figure is, but it's huge. So we're all benefiting from that. Anyway, the point is that the pandemic has driven, because of that Q2, that catastrophic Q2 of last year, has driven the transformation process. So I think those are the two things, Perry, the geographic and the technological. And in my own case, digital, when I left WPP, it was about 40% digital, but we clearly, the model was not fit for purpose. It was too fragmented. We were doing earnouts, but in addition, I was being self-critical. We didn't move quickly enough on digital transformation. And the final thing is, when we talk about faster, better, cheaper, the faster bit is about agility. And if you said to me, if I'm running an established business, what is the key thing? It is agility. I mean, the number of clients who say to me that their organizations should be more agile and faster. I mean, faster, better, cheaper sounds good, but it isn't really. It gets to the heart of it. Better is about understanding the digital ecosystem, and cheaper is about efficiency. It's probably not, it's more about value than cheapness. But agility is the killer. And lack of agility is the killer, and agility is the real, it is so important. And look, why do we like to deal with tech companies? And the reason is, if we say something to them or suggest something, they move at light speed. They'll tell you no, but they'll also tell you yes. I won't go, analog companies or established companies, it kills me to see, A, their inability to take decisions, and B, the politics within the cyber company. It can be geographic, it can be functional. It's a killer. And so that's why I say, what's the biggest problem for a CEO? I think getting everybody to face in the same direction at the same point in time. That's probably the most difficult.
Absolutely. Excellent, Martin. Thank you so much. I have one more question for you, and then we're going to dive into the audience questions. For those participating live, feel free to keep the questions coming in the Q&A box. Martin, my last question to you is around specifically advertising and marketing. What do you foresee, looking ahead, coming years, but also maybe the coming decades? Where do you think the general critical trends are? What framework would you suggest us to use to kind of calibrate our business strategy accordingly? Okay. And of course, if you feel like it, touching on, there's a lot around, potential regulation around social media platforms that are not currently regulated, like publishers. So we'd love to hear what you expect to be the biggest shifts and what you'd want us to keep in mind.
Okay, so I'll give you three things. I mean, the first thing is what I mentioned before, agility, right? So, and within that, when you're thinking about marketing, there are three functions: sales, marketing, and IT. You know, in a bank, which is spending $10 to $11 billion a year, like most of the big banks are, on IT, a lot of the IT is customer facing. It's not internal IT, and yet the CMO doesn't have any input into that, or the marketing function. So if you're CEO of a company and you're talking about marketing transformation, you have to bring the three together. So agility within those three functions from a marketing point of view, absolutely key. That's number one. Number two, you have to take back control. What happened after 2008, after the great financial crisis, you know, the Jorge Lehman, 3G, zero-based budgeting. When I was at B school in 66 to 8, Ling Temco, Vought, and AT&T, Hal Janine's, I think it was Hal Janine who ran AT&T, practiced zero-based budgeting. And it was nothing new, but it was this great new revolution, zero-based budgeting. And Jorge and his colleagues went, you know, Beta Sikapura, I was on the Dean's Committee at HBS with them from 96 to 2003. I mean, they were lauded for it. 2008 onwards, after the great financial crisis, they put great pressure on costs inside the company, and a lot of functions were outsourced to agencies. In a 24/7 always-on world, you have to have control. In-housing, although it may add to your headcount, in-house, there's a Harvard Business School case study, it just came out on Sprint and the in-housing we did at Sprint. We're now doing it for T-Mobile, the new parent. It's worth looking at that case because although it would result in more headcount, counter to the zero-based budgeting core competence thing, in a 24/7 world, when you're really running an election campaign, if you're doing, you know, if you're trying to run a brand or a corporate brand or a service, you're really running an election campaign. Things are coming at you from the competition this weekend, over the Easter weekend, over Good Friday, Easter Monday, Saturday and Sunday. Your competitors and your consumers are going to be changing. They're going to be sending messages and all sorts of things. You have to react in real time. The old model, a 30-second, 60-second TV commercial that takes 3 months to produce, doesn't work anymore. So that's why I liken it to an election campaign. Always on, you're running an election campaign without an election date. So that's the second area. Take back control. Look at what you're doing on content. You know, we build in-house content studios for our clients. We build in-house data and digital media operations for our clients. Not everybody, but we do. So taking back control. And the final thing to your point about regulation, Google nixing third-party cookies, Apple IDFA, first-party data, the data that you have in your operations is absolutely critical. You cannot rely anymore on buying data from outside sources, third-party data, and using them certainly in cookies, etc., because they will be nixed from the end of the year. So using the internal data, lakes, pools, sources of information, absolutely critical, and linking them together in a meaningful way. And it's expensive and it's difficult, and you'll have a lot of write-offs, but you must grab that data, because that, together with the signals from the platform. So, you know, just let me give you the stats on digital advertising. Digital media as a whole is about probably 550 billion last year, about 290 last year, call it 300 for a minute, is digital, just over half. Google's 180, Facebook's 80, Amazon's 20. Then you drop down, Alibaba and Tencent, we really don't know in a Chinese context. We drop down to TikTok at around 7, Snap at about 2.5, and Twitter and Pinterest less than that. The lesson, and I believe Amazon will go from 20 to 100, and Google will continue to grow. and Facebook will continue to grow. I don't think the regulator will break them up. I think they will prevent them from adding, a double click or adding acquisition in Instagram or whatever it is, or the equivalent. But I do think you will continue to see them grow organically at very significant rates. And they are behaving, some may disagree, but I think they are behaving in a much more responsible way. When they hit $1 trillion of market cap, it was a big signal to them that they had to be a little bit more balanced. And with power comes responsibility. So those are the three things: agility, take back control, and first-party data.
William Martin, thank you so much for all of these amazing insights. We've got some really thoughtful questions here. We'll take these quick fire style. So the first one is from Jason Oki. He says, hello, Martin. I spent 10+ years at WPP, and it's always a treat to hear your perspective. One thing I don't hear S4 talk about as much is the power of the creative idea, which of course was the driving force of the advertising industry for many decades. How important is creativity today for building brands? Are clients' needs for creativity changing?
Well, it's fundamental. And it is at the core of what we do. I mean, with all due respect to Jason, is it Jason? Jason? Yeah,
Jason Oki.
Yeah. Right. With all respect to Jason, that, a bit of a cheap shot. It's a bit of a cheap shot in the sense that the creative lion, or rather the people who look back to the era of Don Draper with rose-tinted spectacles, and I mean deliberately caustic, because I think it's something that our industry suffers from. Look back to the days of Bernbach and Ogilvy and say these were the great days when those personalities dominated, and they were great days. But life has changed. And you asked me about the trends. Our model is a data-driven model. We believe fundamentally that data can result in better creative and better digital media distribution. And our business is creation, production, and distribution. That's basically what we do. So at the heart of it is the creative process. But I've got news for you. Things have changed. A 60-second TV commercial that takes 3 months to produce doesn't get you there. By the time you've produced it, the whole world has changed. And of course, creativity is at the center of it. You look at the work, we call our creative business, we built around Media Monks. Our data and digital media business we built around Media Monks. Of course, creativity is at the center of Media Monks. But if I look at the people that inhabit and populate Media Monks and Mighty Hive, they come from the tech platforms too. The two people who run Mighty Hive come from Google through Yahoo, and the third person comes from Salesforce. So we have harnessed, or we're trying to harness, the best of tech and data to drive the creativity. And I do not, this is a rant, but all the flowery stuff around creative, of course it's at the core of what we do. Of course big ideas are at the core of it, but the way that we create them and produce them is different. And it may be, by the way, when we went into the pandemic, thing that really annoyed me was several people in our industry said to clients, you should spend, spend, spend. That was the phrase they used. They actually said it was irresponsible, it was negligent to say that. When clients didn't have distribution, couldn't sell anything, for anybody in our industry to get on their hind legs and say sell, sell, sell was totally irresponsible, bordering on, if not negligent. And it's the same sort of attitude. The nature of creativity has changed. It's become much more technologically driven. It's become much more data driven. It is not like the old days. And it's, so like last week, we won an insurance company, a car and insurance company here in the UK, and they divided the budget. Now they gave the traditional, we don't do any traditional stuff. We gave the traditional stuff to a traditional agency. We took all the digital stuff. That is the way that things, in my view, are increasingly go. And the nature of the creativity is different. It's not Don Draper. You don't spend half the night out partying, carousing, and then get up in the morning on your hind legs and make a brilliant pitch and presentation which wins the business. It's different now. It's much more factually driven, data driven, and I think that creates more powerful insights to drive the creativity. The people at the 4,000 content people, they are bloody creative. And the 800 data and digital people, they're creative too. Believe it or not, data people can be creative.
Thanks so much, Martin, and thank you, Jason, for that provocative question. That was really great insights. Martin, we've got a few more here. Let's do like 1 minute on each to the extent possible. Next one is from Pavel Popov. He says, what is your best advice on a company scaling? What's the best strategy to scale from 30 teammates to 300 to 3,000? And he says also, thank you for sharing your story and your insights.
All right, so organic growth is always stronger, but it's slower. So, scaling is a mixture. So this year, we're budgeting 25% organic growth, and I hope we'll do a bit better than that. And probably we've already done deals this year, which would take us up by about 20-25%. So I would think we'll grow by at least 50% this year. And so I would say the honest answer is a mixture of the two, but organic growth, winning BMW, Mini and Mondelez last year, as they start to kick in this year, was key. They become our third and fourth largest clients almost immediately. So the honest answer is organic growth. And obviously to win that, you have to have really good people, and that, we invest 60% of our revenues in people. So they are our human capital, they're our capital investment. But I would say it's a judicious mixture of organic growth and growth through deals.
Excellent. Thank you so much, Martin. We've got a question from Ming Wu. The question is, you mentioned in that Venn diagram, right? Society and family, all of which certainly affects our businesses. What do you think is happening within society with Stop Asian Hate, Black Lives Matter? What do you think is next, especially in the intersection of business and these critical movements?
Well, I don't know what is next. I mean, we're 40% people of color. So out of our 5,000 people, it's roughly 40% people of color. And we can't get the data in every market for legal reasons, but in most of the main markets like the US and the UK, we can get it. Our Afro-American Black population is about 5% in the US, and we've committed to reflecting the communities in which we work. So it should be 13%, and in New York, it should be 25%. And we're determined to do that. We've set up an internship program. We've gone to the historically Black universities, and we've recruited our first interns for a 4-year program. And we're going to the high schools as well, because it's the kids in the high schools who don't get to university. So we're doing stuff like that. We've changed our hiring practices after the murder of George Floyd. We've changed our hiring and training practices. But I think actually, interesting to the question, procurement is probably the fastest way to get change. So for example, for one of the big tech companies, we won a piece of business recently because we had a diverse team in there. And 40% of the grade was on the diversity of the team. So if we didn't have a diverse team, we wouldn't get to first base, let alone hit a home run. So I think a critical issue. And I heard the guy who's CEO of Merck, Ken Fraser, make the point. I mean, he was talking about hiring practices. It was early on in the pandemic and early on after George Floyd. And he made the point that procurement, we really didn't get into the session how important procurement was. I think that's the next thing that will come, or there is coming big time. That if you're not diverse, this will put huge pressure on companies to move. You're not diverse, you won't get anywhere. So it becomes really an immediate business imperative. Clearly, all the things that we're absorbed with, climate change, the pandemic is going to change working habits. I mean, I'm going to travel less trips, probably longer. Working times, commuting times are going to be varied. We'll have more dispersed working, more dispersed living. We probably will go to 60% in the office on average. I mean, those people who don't have resources at home, who live with their parents, etc., will probably be in the office all the time. But it'll be different also regionally. I think Asia Pacific people will be more in the office. Europe probably less. Maybe the US more varied. And our office space is going to change. We're going to have spaces where people can work, spaces where they can meet their colleagues, and spaces where they can meet clients. We're going to go to unitary building in each city in which we operate. We operate in about 56 cities, but the nature of the space probably will change. So that's where we are there. So I think there will be some significant change. So those are some of the changes that we think will take place.
Brilliant, Martin. Thank you so much. Final question. We've only got a couple minutes left. So final question for you is that you've been so generous with your insights, your wisdom that you shared with us today. Please also share with us, how can we as a community best support you and the endeavors you care most about? And if you have a final word of wisdom for us or a call to action you'd like us to keep in mind, we'd love to hear that too.
Well, far be it from me to advise anybody, because you make good decisions and bad decisions. You do good things and you make mistakes. So the trick is to make sure that the good decisions or the correct ones are greater than the mistakes and the bad ones. So I wouldn't suggest anything other. You can listen to what's happened to me and then you can make your own judgment. I mean, the only thing I would say, when people say, well, what advice would you give? Well, there are probably two things. The first is, I still think you learn code and you learn Chinese. So, I have a young daughter, and she's only 4 years old, or 4.5 years old, and I wanted to learn code and Chinese. That's one thing. The other, and that embodies the technology and the geographic buckets I mentioned. And the other thing is, when you get knighted, you go to the Royal College of Heraldry, or you can do, and you create your own crest. That goes back to the Battle of Hastings and all these crests. And you have a motto. And my Latin, I was hopeless at Latin, but and my motto is in Latin, but the English translation is speed and perseverance. So the only thing I would say is, be quick and responsive. If I delay, it's because I don't know the answer. It's not because, I think speedy response is really important. And perseverance, which is, nothing's impossible. I used to work for Maurice Saatchi, one of the Saatchi brothers, and he loved the nothing is impossible. Nothing's impossible. And actually, one other thing, I was thinking about it last week. Things change so rapidly. So when you're going through a tough time, it's amazing how quickly it reverses. So, the volatility, the marketing VIX, if there was such a thing, is huge at the moment. And that gives us tremendous opportunity. Google's decision on third-party cookies and Apple's on IDFA has caused so much confusion and uncertainty. It's a huge opportunity.
Right, Martin, beautifully said. Thank you. The speed and perseverance, your motto. I mean, you exemplify that in spades, and I believe it comes from your deep belief and conviction and everything kind of you take
And,
on,
pro- and,
and
and
also in your,
probably being an immigrant as well. You know, I'm second generation English, and my grandparents were immigrants. So maybe there's something, you know, one thing, you know, there's a wonderful story. I mean, I read it this week about Albert Bourla, who's the CEO of Pfizer. His family were the Thessalonica Jews who were wiped out by the Germans, by the Nazis. And he was 40, I think it was 40,000 or 50,000 out of 60,000 Jews were wiped out in the camps in the Holocaust. And he went to school in Greece, biochemist, I think, went to America, became CEO of Pfizer, and made sure not only that vaccines were available to Germany, but that vaccines were available to Israel. So I thought that was a wonderful, wonderful story. And I understand he's writing a book about it because, and then, you know, the other one, BioNTech, run by a Turk, Barry. Those immigrants are pretty good.
As an immigrant myself, I totally agree with you, and I'm so grateful for all of the insight and soulful warmth that you came to this conversation with, Martin. So thank you for everything. It was really nice.
One other thing, yeah, I mean, obviously I banged on too long, but if anybody wants to have a chat, martin@s4capital.com, martin@s4capital.com.
We'll be sure to share it up, Martin. Thank you for everything, and hope to see you again very, very soon.
Me too. God bless. God bless.
God bless. Take care. Thanks, everybody. See you all again soon. Bye-bye.